The promissory note, your signature as currency and collateral security. What if your signature had more power than the cash in your wallet? What if every time you signed a promissory note, you weren't borrowing money, you were creating it? This video uncovers the hidden mechanics of the financial system, where your signature becomes both currency and collateral, all hidden under the legal camouflage of the Uniform Commercial Code. In the mechanics of modern banking and commerce, the promissory note occupies a paradoxical status. To the average consumer, it appears to be a debt instrument, a personal liability requiring repayment. Yet in commercial law, particularly under UCC Article 3, a promissory note is a negotiable instrument that carries asset status the moment it is signed and delivered. In truth, it functions as currency, more accurately as the source of new currency. A promissory note is defined in UCC Section 3-104(e) as a written promise, other than a certificate of deposit, to pay a fixed amount of money. This promise is what banks use to access liquidity. Upon receipt of a signed note, financial institutions immediately treat it as a collateralized asset, recorded as such on their internal ledgers. This asset can then be used to generate funds either through interbank transactions, mortgage securitization, or more directly, via the Federal Reserve discount window. More significantly, this note, your signature on an agreement to pay, is what creates the loaned funds in the first place. When you take out a mortgage, the bank does not lend you its own money. Instead, your signed promissory note is deposited as an asset and becomes the source of the funds you are simultaneously loaned. The bank then returns to you the value you just created, calling it a loan. This is not speculative theory. In banking, this process is referred to as monetization of the note. The monetary system depends on this cycle. Your contractual promise creates the deposit, and the bank uses that deposit to justify its credit expansion. Without your note, there would be no funds. And yet, once created, the bank treats the note as its property. The borrower is never told that the note they signed has already been converted into capital and pledged for value. Nor are they advised that the bank has already been paid, either by accessing the Federal Reserve's liquidity facility or selling the note into the secondary market. If the borrower were to include qualifying language such as without recourse, or make a special endorsement under UCC Section 3-205, the bank's ability to unconditionally profit from the note would be curtailed. However, such measures are never disclosed to the public. Why? Because the industry depends on ignorance of the fact that your signature is the real payment. Footnote: this section reveals how promissory notes, upon signing, become negotiable instruments that banks use to create and monetize credit, converting your signature into actual banking capital.